The Strait of Hormuz is effectively closed. Because of the ongoing war involving Iran, one of the world's most vital energy arteries is blocked off, freezing millions of barrels of oil in place. This physical blockade is a symptom of a much wider vulnerability. The World Economic Forum recently evaluated the data and classified geoeconomic confrontation as the single highest global risk of 2026. That anxiety is exactly why President Trump landed in Beijing. It was the first time an American president had conducted a state visit to China in nearly 9 years. With global energy supplies at a breaking point, the White House treated this trip as a desperate attempt to stabilize the economy before the damage became permanent. Immediately after the talks, the administration presented a sweeping list of victories. They announced a massive order of 500 jets for Boeing, highly lucrative trade agreements, and even a guarantee that China would step in to reopen the Strait of Hormuz. But the financial markets disagreed. On the exact day these massive trade victories were announced, Boeing's stock price dropped 4%. Foreign policy analysts echoed that skepticism. Researchers at the Council on Foreign Relations evaluated the summit's agreements and labeled the outcome a modest stabilization, actively pushing back against the idea of a diplomatic breakthrough. This creates a clear disconnect between the political messaging and the market response. To understand who actually won the Beijing summit, we have to look past the press releases and audit the underlying data. Let's look at the actual numbers behind the aerospace deal. While the public rhetoric celebrated an order of 500 jets, the verified purchase agreement signed by Beijing was for a fraction of that, exactly 200 planes. This chart shows how the market absorbed that gap. When the real contract was published, Boeing shares dropped 4%. Wall Street operates on future projections, expecting a much larger acquisition. Committing to just 200 jets signaled a bare minimum effort, not a thriving partnership. In the language of superpower economics, limiting a purchase order to the absolute floor is a calculated message. It maintains a functional trading relationship without offering a rival a significant domestic economic boost. The financial ledger cuts right through the spin. Investors saw immediately that Beijing was carefully managing tension, doing exactly enough to prevent a trade collapse and absolutely nothing more. The dynamic is even clearer in the Middle East. This map shows oil flowing from the Persian Gulf directly to China, giving Beijing leverage the U.S. desperately wants to borrow to reopen the strait. Yet official Chinese transcripts offered only non-committal statements about supporting peace, refusing any specific action. This is a textbook use of strategic vagueness. In modern diplomacy, ambiguity is a highly valuable asset. By releasing broad, generalized statements, China completely avoids alienating